All right, the markets continued their grind. Some up today, some down. The Russell 2000 down a little bit more, and so the Russell 2000 is kind of giving us an interesting pattern in terms of what can lead to some more volatility in the market. So, especially within a couple of sectors that kind of stand out in terms of they've been on a bullish convergence, and now they've gotten to the point where they either bounce off of them or break down. We're going to talk about which ones those were and how that might lead to what it would look like, the weakness would look like, specifically on the Russell 2000. But then we're going to talk about what the more expected scenario would be. What do we expect to see in the type of market that we're in right now? So using the technical indicators to see what we should expect to see coming into expiration, but then what volatility may be telling us about December's expiration cycle and how much volatility we can expect there and where that volatility would be, to the upside or to the downside. We're going to talk about that too in today's video, and what's driving the market, of course. Kind of a risk-off day. We'll talk about what the risk trade is right now and what the safety trade is, and break that down. So let's go ahead and get started. Today is Wednesday, November the 17th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. Let's start off taking a look at the S&P 500 with the market forecast indicator. You can see we had a 0.25% down day today. Obviously did not get a new higher high and a higher low, as you'll see here later today. The near-term line dipped back out of bullish territory, but not completely. And in fact, again, we have a bullish intermediate confirmation signal with the intermediate line well above 80, even it's actually above 90. And then the momentum line oversold, but not to an extreme. So that's by definition is a bullish intermediate confirmation signal. It would be better if the blue line was in bearish territory, because we can bounce off of that, like this one that we got right there, where we had an oversold momentum line and a bullish posture, and the near-term line was in bearish territory, and we were able to bounce off of that. So it remains to be seen if we will bounce off of this particular one. Again, we're kind of in a convergence mode on the S&P. So the moves to the upside right now, after such a strong move, are going to be really grindingly boring to the upside as we kind of converge with this line here back down towards the moving average. You can see you get really high up above it. If I were to show another example from when we were strongly bullish back here, actually in April, when we got strongly above the moving average right there, with a similar type move. This is a very similar move that I've compared us to before, because it was such a strong rally in a short amount of time right there. Not quite 18 out of 20 days, that was pretty rare, but still a very strong rally there. Big move going into the expiration. And then you can see we were, at that point, 5%, over 5% above. Well, let's see, this line here is at 4.38, so pretty close to 5% above the moving average. And then we just started to grind our way down towards the 30-day at that point. So very similar type of pattern going on here. We actually got up to 4.84 on this one, and now we're grinding our way down towards the moving average, right? And it doesn't mean that we're going down. It just means the moving average, we're not going up as fast as the moving average is, and that can at least catch up at some point. So look for potentially a good bullish end of the week. I don't think that we'll follow through with any weakness here tomorrow. I think we'll just grind our way up towards the high yesterday and towards that high there tomorrow. So I don't expect a big move. I mean, today's range was less than half of normal. So I expect that we'll have even less, still less than average range again tomorrow, and that average will just keep dropping down. As you can see, these are really strong numbers. A one-year return of nearly 30% is a really strong number, but even that return's not nearly as big as it has been. You look at the NASDAQ, which is the main driver right now. There's a lot of lines here. Let me just get rid of all these lines, so it's a little easier to see all what's going on here. And then we'll get rid of this one too while we're at it. So you can see the posture here. We are just grinding our way up, dark green shading and a green line. We peaked over here at about 7% above the 30-day moving average, and now we're working our way back down towards it. As we go up, the moving average just goes up faster. And you can notice the Near-term line did get back in bullish territory, just barely, but this is back in there. It hasn't dipped back down yet like the S&P has, and we don't have an oversold momentum line like the S&P, so not nearly as bullish. The Russell 2000, on the other hand, is a little bit more bullish than what we've seen. The near-term line is in bearish territory, so is the momentum line, and we don't have an intermediate confirmation signal here because the intermediate line has dropped below 80 now. It would have to stay above 80 with that oversold momentum line, and it's actually below. If you notice up here, we actually closed lower than all of these lows, like that big down day there that we had bounced off of and rolled up, and looking like this was a little near-term rally. It's not. This is actually still one big near-term pullback of this particular near-term rally. We are kind of sitting here at about the 38% retracement of that near-term rally there. After that 2-day pullback that brought the near-term line into bearish territory and back up and then back down, and we're still down. Getting above 50 doesn't end it. It's got to get back into bullish territory. So we'll see. There's some good support here. Obviously, there's a little bit more support down here at the 30-day moving average if we were going to go through that. So just keep that in mind. That's a little bit more bearish than what we see on the S&P because we actually did close below that low point there. Looking at the Dow Jones Industrial Average also looks a little bit more bearish than the S&P. As you can see, a little bit more of a down day. The near-term line, a little bit closer to average on the range. The near-term line back into bearish territory. We do have an intermediate confirmation signal here. The difference between this one and what you see on the S&P, we are above 80. We are below 20 on the momentum line, but the momentum line really got down to extreme lows, all the way down to the 5th percentile. It's a little bit of a red flag. So, again, we can bounce off of this, and probably most likely will bounce off of this to finish a couple more days going into expiration. But and we didn't quite finish below these lows like the Russell did. A little concerning though from that perspective. But again, very typical of what a grind looks like. If you look at the S&P, like last week we didn't get a close above the prior week's high point, and this week we're not either, and you can see the candles are getting smaller, the Hakinashi candles. That's a convergence. It's very, very typical of a convergence. Obviously we don't have a red arrow and we're not anywhere close, but that's what that looks like. The Dow Jones, you remember, is a little bit more bearish. It's actually got a lower shadow now. So it's getting a little bit of that's a transition candle. You can expect some bearish weekly candles to come out of this. The Hakinashi differential is way close to zero there. And then when you look at the Russell 2000, which had such a one really big bullish week here, we were unable to follow through with a close above the prior week's high. And then now look at that candle, very, very small. So very quickly, back to a reversal type candle, a little bit of a lower shadow here too. So and the differential really dropping down. So boy, if this turns into a fake out, that would be probably the mother of all fake outs, because a lot of people have looked at this breakout as a breakout that could lead to good extended runs and sucked in a lot of money, anticipating a long trending breakout pattern. If we end up faking out, that's going to bring a lot of people with some weak hands that would put some pressure on the stock. Let's take a look at the 3 green arrow charts here. So again, we don't have light green shading on any of them. We don't have pink shading either, so we don't have 3 red arrows. And some of them we only had the 1 red arrow. And, the green arrow is on the stochastics for the S&P and the Qs. You can see the diamonds, but no pink shading yet. And remember, if we get pink, you might get a day where you just bounce right back up. Or 2. So when we get the pink, it's got to stay pink for us to be in an intermediate decline like we were in this stretch. So we're not bearish, but we're also not as strongly bullish anymore. Let's take a look at the 2-line versions of these charts, and you can see what I'm talking about with the convergence. The MACD is below its moving average. They're both falling, even though we're still rising above the 8, right? But we're rising at a much slower pace. The 30-day has crossed above the 50, so you got a little bit of a golden cross. We're not in any danger of any kind of intermediate declines, because you don't even think about that until you break the 50. And the bigger the gap between the 30 and the 50, the less likely we are that the next little drop will be an intermediate decline, because the 50, there's a good chance it would hold in that situation. Remember, it's a little different scenario on the diamonds. The diamonds did break its 8-day moving average. Still, remember, didn't break through those lows, so it's actually still holding the 17-day. And it's a little bit more different on the IWM, that actually is flirting with the 17-day and broke below all of that. So a little bit of a difference there. Remember that, and the Russell is actually a lot closer to its 200-day moving average. And then you got that convergence. So, this bullish convergence steepens when you break the 17-day moving average. So very, very important tomorrow that the Russell and some of these other indexes bounce back up into expiration date to maintain a very boring convergence rally, where we rally up above the 8 while the MACD stays below its moving average and gets closer to 0, but at a much slower pace than when you break the 17-day and stay below it, and then you get to 0 very quickly in that regard. So that's what's going on there on that particular chart. If you take a look at some of the other oscillators, let's kind of focus. You can see how bullish we still are on the S&P, but for a look at IWM, like we are pretty much below 20, almost below 25 there, and we're already above 20 in the negative. So that quickly, the ADX is back down below 25, and that trend is excuse me, pretty close to being done. Look at the RSI and the CCI. Very bullish here, but you see the divergences, or at least you see the lower highs already developing. If we were to get slightly higher highs, we would be definitely in divergence territory there. But again, look at the Russell 2000, and it's less bullish, right? We are easily back below 60. We are into negative territory. More a sustained breakdown would be, getting back towards that 62%. We'd be back below those highs. It'd be very, very fake out-ish if that were to happen. And then finally, let's look at very strong trending pattern here on S&P, well above the cloud, still above its green line. The diamonds still got very strong, above 80, above 5, but not above its green line. Well above the cloud, but not above its green line. And then IWM has been now down below its green line for 3 straight days. You still got very mature trending, so very important, again, that we bounce back above that green line and keep these numbers up. Otherwise, once these two things hit 0, because that's how you end these trends, they both hit 0, then we stop trending, right? We were trending, we hit 0, we stopped trending at that point. We just kind of went sideways. So just like that. So very important we bounce up off of that here. And finally, looking at the Bollinger Bands, you can see we are still in the upper quartile in the S&P. That's great. The diamond, we are in the middle quartile now. And then IWM, we're actually back down to the middle too. So you come down to the middle and you bounce, come down to the middle and you bounce, or you come down to the middle and you stay, right? So it's important. We came down to the middle here and bounce. We come down to the middle and you expect that we'll bounce until we don't, right? Until we see some of these other patterns here. All right. So that's what all the major technical charts are looking at. If you look at today's intraday chart, you can see an inside day on the S&P, kind of at some resistance at last week's high point, so really kind of unable to get through last week's high. IWM, we got a lower high and a lower low, and we closed below yesterday's low. We closed below last week's low, when there's a relatively decent sized gap in volume that can lead us all the way down here to this 228. So IWM is kind of knocking on the door of more weakness. And you remember, getting above the 0% line is that old high point that can act as again, that's the breakout that would turn into a fake out if we got back down below it, 234-ish. So really, really important 2 days for small caps and how we finish out this week. And let's take a look at today's volume and trading range. For SPY, you can see the volume 47 million, very small range. Again, like I said, less than half. IWM, we were actually above average, and we had closer to average range, so a little bit more bearish on there. You take a look at that 3 points and the 26 million down there at the bottom. If I put those numbers into context here on IWM, 3 points, so it's a very low ATR as it is, below 1.5% down here, so it's relatively extremely low for where it's been, but volume has been picking up here on the downside. And if ranges start picking up again, would be more bearish when these things go up instead of bullish. They typically go down. You can see SPY. As we've been bullish here, you see the drops, and I mentioned this too. For for this to get down to 75%, coming off of the last intermediate low point, for us to get down to the 75% mark, it took all the way from the low point on Halloween all the way to roughly about July before we finally got to 75%. On this current intermediate pullback that we've had, we've gotten down to 75% within a month. So that quickly. If you look at the volatility index here, which you can see we're still extremely low, we're below the 80% mark. When you look at the last recession here, coming off that Halloween low point, it took all the way to mid-February before we got to 80%. We got to 80% within a couple of weeks off of that one. So you see how this particular intermediate pullback was very, very weak, and just like that, we're already to extremes in terms of how little volatility we have going on. So again, it makes it more likely that by December expiration, the volatility index will actually probably be higher than 17, then it will be lower than 17 because of how extremely low we are. And also too, keep in mind that this particular expiration cycle has had it's picked up a little bit in the last couple of weeks, but still your range is just barely over 5 points, and we're sitting at extremes. That's the kind of conditions that leads to a move. And I mean, look at all these long upper shadows, these early jumps that we get in volatility within the expiration cycle. That's something you'd expect to see here. That leads us up to, because you can see if you look at the ATR right now, the range for this expiration cycle is 25 points, but when you look at the average range for the VIX on an expiration cycle basis, so like similar to a monthly chart, the average range is 11.5 points. So only being at 5 points is well below the average. That's the kind of conditions. Last time we had 13, that was above average, and so we've now come back down to 5. We're back below average. That would suggest that next expiration cycle, or at least sometime soon, we'll be back up towards 11 points or more. And remember, if we go up 11 points, have 11-point range between 15 and say 26, then that's your typical range. That's what it would look like, because we're not going to get between 20 and 10. Like, we're not going to drop below 10 by December expiration. So it would be to the upside that you'd be worried about most of that average range to occur. So again, what do I expect to see here? Well, most likely by the end of this weekend, we'll bounce off of this little weakness we've had today, and grind, right? And bullish convergence conditions, just grind up, very small ranges, very small volumes, very boring. And so that's what I expect. That's the most likely scenario. That's the highest probability scenario. There is a low probability scenario. I don't expect this to happen, but it's a possibility that we need to be aware of, that we get a fake out on the Russell 2000, that we continue the weakness going into the weekend. We get back into the range that we had broken out of a couple of weeks ago, with some bigger ranges, and that might lead to more of a faster convergence condition than a slow grinding one. Getting us back to the moving average is a little bit quicker than may be comfortable for some. So I don't expect that to be the case, but that is a low probability scenario that we need to be aware of, because that can occur as quickly as tomorrow or Friday. So we'll kind of keep our eyes and see if that's the case. Otherwise, slow grinds to the upside. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that would suggest why you're either a lot more bullish than I am or a lot more bearish than I am? Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. You liked our video today and you want us to do another video again tomorrow. Quick way to give us feedback if you like our stuff. Of course, if you don't like our stuff, you don't have to click on anything. You don't even have to watch if you don't want to. Also, comment down there. What did you get out of our videos today? What stood out to you? What questions or comments do you have on anything I brought up? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content from between the videos from day to day. There's my handle, at DavidSettle42. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us here on our blogs, check out some of these things over here on the right. If you click on the Market Outlook image right here, it takes you to this page. You can see all of our Market Outlook live archives, as well as watch on Monday, Wednesday, and Fridays at 3:30 Eastern Time, like we did earlier today. I did a Market Outlook like I reviewed all the trades that we've been doing in these Market Outlook videos to see whether we should stay in them, get out of them. We actually rolled one of them today, so we talked about that. And I also put on today's trade idea. You'll see at the end of the video, we already put it on today before the market closed. So that's where you can see that. Come down here, you can see our upcoming classes. Click on View More, or you can click Trading Rooms. It takes you to our calendar with all of our upcoming classes, all the recordings of prior classes there. Come down to the bottom, hit that heart button. It opens up a new tab. Hit that like button there. Also click the thumbs up icon here. It opens up another new tab, and hit that like button there. Again, the more you do that, it helps us get our content out to all of our followers. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to just go ahead and engage with us right here. You can do right now while you're watching. Alright, so you can see from this chart that today was a risk off day. I mean, this is our risk trade right now. Is the emerging markets, commodity prices, and small cap stocks. That's your risk trade right now. The safety trade is gold, bonds, real estate, and the Qs. Right, the Qs, remember, are our safety trade. They can also be a risk trade too, obviously. But when the markets are in risk off mode and it's they can outperform, as you see that they have. They outperformed. Even high yield. All of these bonds, even during a pullback in risk appetite. 0.5% drop for emerging markets. You can see small caps really dropping, commodities dropping. The dollar was down today. If you take a look at the dollar, it's been a big mover here recently. After getting an overbought cluster, we've pulled back down. A little bit of a drop, so not very much of one, but enough to get the momentum line. Again, another intermediate confirmation signal. The difference is the near-term line's already way up there. So we'll see if it follows through like it did last time with this one, where we just came up, had a little bit of weakness, and popped back up. But the difference this time is we have a cluster. And last time we got a cluster was back over here, and that turned into kind of a near-term peak for a while, as we had an intermediate decline there. So very, very important to see whether or not we break down here tomorrow. If you look at the intraday on UUP, interestingly enough, it's been bullish on risk appetite, and very well could be more bearish if we're on risk aversion mode, which is not something you expect to say with the dollar, that it would actually go down when stocks rally, but that's the correlation right now, because it's really the euro that has been the big the big weakness in the euro has fueled risk appetite, and if the euro would start to rally, that might put some pressure and create some volatility there. So a big drop lately in the euro, and if you take a look at long-term bonds, big engulfing pattern. So we've had this near-term decline. Look at that engulfing pattern there, possibly a bullish reversal pattern for bonds. So again, can that lead to some more upside, some more risk off type moves? And you can see the gold had a little bit of a down day, brought the near-term line into bearish territory. Are we bouncing back up now? Again, another risk off type trade. So very important inflection type point that we're at here. As you can see, the commodity prices are below the moving average again, well below the moving average. In fact, when you look at commodity prices on this chart, they are we've been below the 17-day moving average now for multiple days, and look at that big gap in volume. It's going to be very, very easy for it to break that 50 because there's no volume there. And if that's the case, most likely would occur during a risk-off period, a risk aversion period. So again, very, very important to see how we react to this risk-off move today, if it's just a one-day phenomenon or if it's the beginning of something more. I expect it will be more of a one-day phenomenon, and we'll get back above here and finish, like I said, at expiration. But after expiration, then all bets are off at that point. Let's take a look at the major global markets. Get the 12 grid here, and you can see where a lot of weakness in emerging markets. Of course, Brazil is still weak. Look at Russia is breaking down now, well below its moving average. China had a big down day today. Japan, a lot of these European developed markets are all still in convergence mode, including Italy and India also in convergence mode, and Korea still in a bearish trend. So it appears to be the U.S. that's still the lone bastion of strength right now from a global standpoint. If you take a look at the sector rotations, sector moves, let's look at the comparison chart just for today alone. Remember, we had the asset class chart showed that kind of a risk-off move. Well, the sector rotation, you can see the big winners today: utilities, healthcare, real estate, all risk-off, but consumer discretionary. So that's not really your risk-off. And down at the bottom, your cyclical sectors were your biggest losers: industrials, financials, energy, materials. So you can see why the small cap stocks struggle so much, because those sectors are pretty correlated, more correlated with small cap stocks. Let's take a look at their 12 grid here. Remember, discretionary is kind of has some strength. So has technology, kind of in bullish convergence mode. The communication service is not doing anything. You can see industrials and materials is kind of their first days of weakness. Financials may be breaking down, light pink shading in a yellow line. So we need to bounce off of this immediately. Same thing with energy, light pink shading in a yellow line. So we've been converging. We've converged to the point where we either bounce or we break. Right, this is this very well could be the end of the convergence for those two. So we either bounce and get a new divergence to the upside, or we break and get a divergence to the downside. And you can see the strength in the safe havens down here at the bottom. So very, very important, especially for financials and energy, as they've been big drivers for small cap strength here lately. It's going to be very important to see what this convergence leads to. I would expect that they would bounce. When I get this pattern, I expect to bounce until I don't get one, right? You expect that the trend will continue because trends are so strong. So I expect that they'll bounce going into the weekend, and if they don't, then that's the low probability scenario, like I said, that we need to at least be aware of and know that's a possibility and watch for it, even if we are expecting to bounce off those levels tomorrow. All right, so for our trade idea of the day, I'm going to take a look at Apple. Apple's had a nice little breakout pattern. Dark green shading in the green line, so we had a little bit of a near-term decline. We bounced out of it. The momentum, the intermediate line has been flirting with that 80th percentile pretty much all day today. Finished down because we finished off the highs, but we still closed above all these highs. So still a very strong close, moving well above the moving average, 3.5%. Near-term line getting into bullish territory again, so we're starting a new near-term run. If you take a look at the weekly candle, Hakinyashi candles for Apple, you can see that we're getting a good bullish candle here, and closing above last week's high so far. Again, remember we were up higher, so we'll see how we finish the last couple of days, because if we finish above all these highs too, it'd be a very strong candle for Apple. When you look at its 3 green arrow chart, we are above the 8-day moving average and the 17. You see the 30 has just recently crossed above the 52, so we got a good bullish pattern developing. We're above the value area, or above the one big strong volume node that we had above the value area. So good chart from that perspective. You have a good DMI. We're above 30. We're below 20. So a breakout pattern on the DMI pattern with the ADX at low levels, ready to rise and start a new trend. We have RSI is above 60, CCI is well above 150. So good bullish patterns on those as well. Looking at the trend strength indicators, we are above 2 and above 65, so starting to get some good trending patterns going here, well above the Ichimoku cloud up there. Looking at the Bollinger Bands and the Keltner channels, you can see we actually finished outside, well outside the upper band, and those bands had really squeezed to the point where they were well inside the Keltner channels, and now we're kind of in between. We were actually outside the Keltner earlier, so we have an opportunity. Last time we broke above the Keltner, the bands were outside. This time, where the bands are inside and ready to trend. So an opportunity here for some positive momentum to lead to some green dots and a breakout pattern on this Bollinger Band. So good bullish opportunity for Apple. So what we decided to do was to come over here and buy the at the money put for December expiration, where we're going to sell the 160 put to keep the cost down, about half of that. So what we did is we put about half my normal risk. So this is my normal risk for a directional trade, which is half my normal risk for a non-directional, for a high probability trade. So just $500, and then going for about $1,000 reward. So about a 2-to-1 reward to risk ratio. And you can see where the max gain is in terms of a 1 standard deviation move between now and December expiration. So really good opportunity to get a relatively high probability for a directional trade. We're down just a little bit since we got into it, but you can see what the reward is. And if we do keep coming down, if we come down here to, oops, not that one. And actually over here too, just to kind of show you this, we got 3 green arrows again. So we had dark green green shading for a while. We went to clear, and now we're back to 3 green arrows and above average volume on the 3 green arrows. So good move from that perspective. And if we do pull back down, we've got some support here. At that 8 and 17 day moving averages, right about $150. And if we break that, and we'd be losing, it looks like a couple $100 between now and then. So we can keep our risk even smaller than that, if knowing that the trend that we're buying here, the bounce that we're buying, is not playing out and has reversed. So that's how we can keep our risk small and go for a really good reward relative to what our risk would ultimately end up being. Alright, well that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new threads with any questions or comments you have. Reply to anybody else's threads, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Like us on Twitter and Facebook as well. Comment on the video. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.